So you recently decided that you're tired of working a 9 to 5 and you're going to open your own business. You've already decided what your business will do and when you want to open for business. The next step is deciding on what business entity works best for you. You have 5 business entities to choose from. And obviously the best choice is, it depends. Welcome to Hustle Libraries, where we talk about all things money, business, and tax. Today we are taking a closer look at the 5 types of business entities and things to consider when deciding which is the best fit for you. Let's go. To start, what is a business entity? A business entity refers to the type of organization or structure of your business. This has nothing to do with what the business actually does. As I mentioned earlier, you have 5 business types to choose from. They are sole proprietorship, partnership, S Corp, C Corp, and limited liability company or LLC. When considering which business entity to choose, there are 3 main factors to consider: the ownership, owner liability, and tax. When I say ownership, I am referring to the number of owners and the types of owners, because an owner can be a person and in some cases a business. A sole proprietorship owner must be an individual, and the owner must be a person. In contrast, a C Corp has no limit to the number of owners it has, except these owners do not own the business. They own shares of the company, so they are called shareholders. And a shareholder can be an individual person as well as a business, like a partnership or other corporations. An S Corp is kind of similar to a C Corp because the owners are shareholders, but with a lot more restrictions. S Corps cannot have more than 100 shareholders. These shareholders can be individuals or certain estates and trust, but other businesses cannot own shares. Owners of an LLC are called members, and the number of members allowed depends on the state that the LLC is organized in. There are some states that require at least 2 owners, but generally it is 1 or more owners with no limitation. By definition, a partnership is formed when 2 or more individuals or businesses engage in an activity together with the intent to make a profit. They have no limitation to the number of parties involved. Liability. Liability refers to the amount of exposure of the owner. It's either limited or unlimited. If a business owes money to a bank or other third-party creditors, and the business cannot pay, an owner's personal assets could be in jeopardy. If you have unlimited liability, an owner has no protection, and creditors can go after the owner's personal assets, such as their home. If an owner has limited liability, then the owner's personal assets are protected. Creditors can only go after the business assets, and personal assets are not in danger. A sole proprietorship has unlimited liability. Personal assets are not protected. There are several different types of partnerships, but every partnership will have at least 1 partner with unlimited liability. However, there can also be partners with limited liability. This will depend on the partnership agreement. S Corps, C Corps, and LLCs are all limited liability. And last but not least, tax. One important thing to understand is that not all businesses pay tax. Let me explain. A business can be considered a business entity by a state, but the individual owners are responsible for paying the business taxes on their personal tax returns, while other businesses are responsible for paying their own taxes on a separate return. So the important thing to consider here is who is paying the tax. In the eyes of the IRS, a C Corp is viewed as a living, breathing being separate from its owners. These entities are responsible for paying their own taxes, which are filed on Form 1120. Sole proprietorships, partnerships, and S Corps do not pay tax themselves. Instead, the owners pay the business taxes on their personal tax returns. These taxes ultimately get filed under Schedule C of Form 1040. LLCs are quite special though. These entities can be taxed at the owner level on Form 1040. They can choose to be taxed at the corporate level as a C Corp on Form 1120. And they can also choose to be taxed as an S Corp, which they will file on Form 1120S. So there you have it, the 3 important things to consider when choosing a business type. There are many more differences between these entities, but we will cover those in future videos. If you got any value from this video, consider sharing it with a friend. Subscribe for future similar videos. And if you have any business, investing, or tax questions you want me to make a video on, just drop it in the comments below. Alright guys, thanks for watching. See you next time.